We now move on to the first panel of the next session. It's done in conjunction with our 9-year-long partners, EY. And to set it all up and ask questions, sector and strategy, how are the sands shifting? A man for whom the letters EY stand for eternal youth, Harry Nicholson, partner at EY.
Golly. Thank you, Tim. Good morning, everyone. And on behalf of all the EY teams that advise and serve this industry, thanks for the opportunity to make this short presentation this morning. I'd like to share some facts and perspectives on the topic of this summit, sectors and strategies, by taking a market perspective. And that is based on two complementary data sets that give us a pretty good insight into what's going on in mid and big cap investing in the UK and across Europe. And for that, I would like to thank many of the GPs and portfolio companies that provide that data. Let's start by just giving the industry backdrop. This chart, some of you may have seen before. This looks at all of the businesses owned by private equity across Europe, measured in their aggregate entry enterprise value. And the trend here, I mean, you've seen this stats in many different ways. Fast growth in the late noughties, steady decline since the peak of 2008, and interestingly, some growth in the last 2 years. So growth in the aggregate sort of economic value of businesses in the mid and big cap space in Europe under PE ownership. But we would say that this growth is still not healthy growth. If you take a 5-year hold, then you'd expect about 20% of your portfolio value to change every year, to be sold and to be bought. And it looked a couple of years ago that we were headed that way, back in 2014, 2015. But we can see in the last couple of years, the growth in portfolio value has come from a reduction in exit activity, despite very attractive market characteristics and valuations. And exit level down at just over 10% suggests really quite extended hold periods. That's not healthy long-term for returns. Behind that, as we have talked about in previous years, there is wide differentiation by GP. The winners, the young GPs, we called them last year, are far more active buyers and sellers, and their ratios are comfortably at or above the 20% level. But the industry still includes a number of players who are transacting much less frequently and presenting a drag on the overall industry perspective. And it's interesting just to comment on the hold period, how you sort of look back to 2004 to 2008, or 2005 to 2008, and then compare that to the 13-14 track to 2017, hopefully not similar points on a cycle, you do see some evidence that hold periods are lengthening. There are certainly fewer fast exits in the current environment than there were at this point, essentially, back in the late noughties. So with that as a backdrop, let's think about this question, are the sands shifting? Let's start by sector. And for those of you who are sitting close to the screen, some of these charts are going to be pretty psychedelic. I found that out myself earlier. So this looks at new deals, just new deals, by sector, aggregated into these 6 categories. It's hard to see major shifts. A couple of points I would draw out. We'd heard earlier this morning about technology, and it does look like, and we will certainly see, sort of secular growth in the tech sector that probably has a long way to go and will have a profound impact on the whole economy, let alone PE investing. I would expect to see that a much more prevalent trend in venture capital and growth capital sectors than we see in big cap. It might be dangerous to comment that the sector at the bottom which we would characterize as being most cyclical, so chemicals, construction, resources, has been on a downward trend. Possibly that's the right thing to do at this stage of the cycle, where the macro risk is probably on the downside rather than the upside. Let's see. Shifts in strategies measured by PE funds and sort of funds, the fund types that are playing in mid and big cap PE space, no evidence. There have always been a small number of infrastructure investors, sovereign wealth funds, occasionally hedge funds, distressed funds, who are investing in this space, but no evidence that that's shifting. This industry is being led by private equity investors. So far, it's hard to see a Brexit effect, although clearly the true risk lies ahead of us. The UK has maintained a very steady, albeit year-on-year sort of volatile, share of new deals of around 30 or so percent, which is just interesting to note. Let's see what our politicians bring us over the next year or two. And just as an aside, if we turn to think about results and realized returns, our data shows that in this mid and big cap space, the UK continues to be a good place to invest, measured by realized returns. We see that return levels are close to the all Europe average. We see in the chart on the right here, if you look at the top, the sort of yellowy gold, the returns, the deals that generate more than 4x, which really do impact the industry returns. That's the right skew in the distribution curve of returns. There is a good chance of doing those in the UK, just as there is across all of Europe. And I think that's important because many say that the UK is the largest single market, but it's also the most developed, the most mature, the most competitive, and it's good to see attractive returns being earned. So nothing we've seen big picture in sectors or strategies, but there is one theme that we wanted to draw everyone's attention to, and that's about provenance. Where are new deals coming from? What's the type of the seller of businesses to private equity? And here we can see one big shift that's been evident for some years now, and that's that PE is sourcing about 60% of its new deals from PE. And that is twice the level that was taking place in the late noughties. The trend line there, many statisticians will argue with that, but it does show a marked difference in how the industry is sourcing new business. And I think that has two implications. One I'll talk about here, which is it has some impact on the long-term growth potential of the industry, because there is a constraint of how much you can grow in this space if you're having to buy from other PE firms. That does constrain it. It doesn't stop it, but it does constrain it. I should also point out that our latest research on corporate intentions to divest, our global divestment survey, does show corporate intentions to divest are at an all-time high, and startlingly twice the level of the same research done a year ago. So hopefully that gives news to the corporate route to market. Second point I wanted to make is, this is interesting, this looks at the same data but cuts it by deal size and shows that actually buying from PE is important across all deal sizes. It's not just at in our data here, the lower end, the mid-market 250 to 500 end. It's also an important mix of new deals in the largest deal size. And that has some implications beyond sectors to also think about the skills required to make these deals most successful. Buying from PE is typically about growth, about new products, about new markets, about digital. Corporate carve-outs are often quite complex to separate from their former parent. They often require transformation of many, if not all, aspects of their processes, their products, their management teams, their IT. And I'll leave it as a question that the panel may pick up on as to how much we're seeing GP focus on those two different skill groups, or indeed whether those two sets of skills and routes to value creation can happily exist under the same roof. I'd also just point out in terms of returns on PE, again, same display as earlier. When we first started doing this work some many years ago, actually returns on PE deals on secondaries outperformed returns on primaries. But that has now changed, and the evidence here shows there's still good returns on secondaries, but they are lower than from other sources. And why is that? Well, the chart on the right gives you a clue. It's pretty much the same downside risk, which is interesting. They're not safer deals, same chances of losing money, but there's less upside. There's that little bit of gold at the top that really matters to what the average returns are, and there is less chance of a knockout deal if you're buying from PE. Lastly, just to show a tiny bit of data on a tiny trend, there are a very small but growing number of perpetual PE holds, long-term PE holds that we see in portfolio over the last 12 years now. Some people are talking a lot about this as a new theme to put money behind. It exists, but it still looks very small. So in conclusion, let me say that industry activity has picked up, but it's not, in our view, at healthy levels. At an industry level, there's wide variation by GP. On the topic of shifting sands, do we see any major evidence by country, sector, fund type that might reshape the industry? I've shared some facts and perspectives that say broadly no, from a market perspective. But we do see this trend to a rising share of PE deals sourced from PE, and leave you with the thoughts about what that means about long-term growth potential in the mid and big cap, and also what it means for GP skill sets and the focus of their origination, but also their value creation teams. Thank you very much. And